Most people believe that lowering a balance automatically improves how lenders see them, and technically it does. But lending systems are not only measuring whether a number decreases, they are measuring how it decreases. They are measuring the path. They are measuring the pattern. This is where partial paydown patterns matter. A partial paydown is when you reduce a balance gradually over time instead of eliminating it all at once. This is normal behavior. You use a card, you make a payment, you use it again, you reduce it again. But to a lending system, those reductions are not random. They form a visible behavioral sequence, and sequences carry more weight than isolated actions. Imagine two borrowers. Both start with a $7,000 balance. Borrower A reduces that balance by $600 every month for several months. Borrower B keeps the balance near $7,000 for most of the year and then suddenly reduces it to $1,000 in one large payment. Both have lowered their balances. Both have improved their utilization. But the behavioral story is different. Borrower A demonstrates ongoing management. Borrower B demonstrates sudden correction. Neither approach is automatically negative, but steady reduction builds stronger behavioral predictability. Predictability lowers uncertainty. Uncertainty increases perceived risk. Partial paydown patterns reveal whether exposure is being managed continuously or only adjusted under pressure. Gradual reductions suggest stability. Sudden large reductions suggest reaction. Reaction is not punished, but it does not build the same long-term classification strength as sustained, visible improvement. Lenders evaluate trends across time. One large payment changes a ratio. A series of moderate payments changes interpretation. Direction matters. If balances trend downward month after month, that communicates decreasing exposure. If balances remain elevated and then drop sharply, the improvement appears recent and untested. Time builds credibility. Repeated cycles build confidence. Now connect this to reporting cycle alignment. If you make a large payment after your statement closes, the higher balance may still be reported. If you reduce the balance before the statement closes, the lower amount becomes visible. Visibility shapes perception. Partial paydown patterns only influence underwriting when they appear in reported data. Timing determines what the system records. Now connect this to payment cadence. If your payment rhythm is consistent and your balances decline steadily, that reinforces behavioral clarity. If your balances fluctuate dramatically and payment timing shifts unpredictably, the profile becomes harder to interpret. Clarity reduces uncertainty. Volatility increases interpretive complexity. Volatility does not automatically cause denial, but stability strengthens approval confidence. Here is the practical takeaway. If you are working to reduce debt, consistency is more powerful than dramatic change. A single large payment may improve your utilization instantly, but repeated moderate reductions across several statement cycles create a stronger behavioral signal. It shows control. It shows planning. It shows sustainable direction. Lenders are not measuring effort. They are measuring repeatability. Repeatable improvement builds statistical confidence. What matters most is that improvement remains visible across multiple cycles. If balances decline for 1 month and then rise again the next, the signal weakens. If balances decline gradually and continue declining, the signal strengthens. Lenders measure durability. Durability is built through sustained reduction, not temporary improvement. Temporary improvement adjusts a number. Durable improvement reshapes interpretation. Now consider another subtle detail. If balances stay high for extended periods and then fall sharply right before a loan application, the improvement lacks historical reinforcement. It may still help, but it does not carry the same weight as a documented pattern of steady reduction over time. Underwriting models value observable history. The longer the pattern, the stronger the classification. Partial paydowns also interact with overall exposure pressure. High utilization sustained over time signals ongoing financial strain. Gradual reductions relieve that pressure slowly and visibly. That visible relief builds interpretive strength. Even small reductions, when repeated consistently, communicate greater control than large irregular swings. This is not about manipulating numbers. It is about understanding how behavior is recorded. Lending systems evaluate movement across time. They look for direction. They look for consistency. They look for stability. Reducing balances steadily communicates manageability. Sharp swings communicate adjustment. Both improve numbers, but one builds durable behavioral identity. Layer 1 is about behavior. Behavior becomes powerful when it is repeated across cycles, across reporting periods, across months, across years. In the next episode, we move into long horizon stability. Because once a reduction pattern exists, the length of time it is maintained determines how deeply it strengthens your financial identity.